From your very first trade, emotions reveal themselves as a driving force behind every trading action you take. Have you ever stared at your screen, heart pounding, as your first live position ticked against you? It's in these moments, Richard L. Peterson argues, that you truly meet the market, not as a rational machine, but as a mirror for your own emotions. You may enter the trading world convinced that knowledge, analysis, or a bulletproof strategy is all it takes. But the truth is this: your emotions are already in the driver's seat. You might recall the surge of excitement when a trade goes instantly in your favor, or the anxiety as red numbers flash, tempting you to bail out early. Peterson shows that this isn't a sign of weakness, it's biology. The same neural circuits that helped your ancestors survive on the savannah now fire in response to flashing candlesticks. Dopamine spikes when you anticipate profit. Cortisol floods your system at the first sign of loss. Your trading desk becomes an emotional cockpit. Consider the opening chapter of Psychology for Traders. Peterson recounts case studies of both retail and professional traders who, despite years of experience, continue to grapple with emotional surges. Their stories are your story. You may catch yourself rationalizing a risky entry or doubling down after a small win, thinking you've finally got it. But is that logic, or is it the rush of emotion? Think of Mark Douglas in Trading in the Zone, his warning that the market is never wrong, opinions often are. You can have all the technical knowledge in the world, but if your emotions aren't managed, those opinions will override objectivity every time. Or Brett Steenbarger's observation in The Daily Trading Coach: markets will test you, and they'll keep testing you until you change. Peterson's work echoes these sentiments. Trading is not just about charts, but about confronting your most primal responses. Every time you place a trade, you open a door to your own psychology. You can rehearse entries and exits 1,000 times on paper, but real money changes the game. As you hover over the buy or sell button, you may hear your inner voice. What if you're wrong? What if you miss out? This is not just you. This is every trader, every time, facing the emotional gauntlet of uncertainty. This is why so many traders fail, not because they lack knowledge, but because they underestimate the power of their own feelings. Peterson uses scientific studies to reveal that decision-making under risk is fundamentally emotional. The data is clear. Consistent winners are those who recognize, accept, and work with their emotions, not those who try to suppress or ignore them. Imagine the first time you deviated from your plan, chased a loss, or let a winner turn into a loser because you felt it would come back. You're not alone. These are universal rites of passage in trading. Peterson's stories and neuroscientific evidence drive home this point. Emotional discipline is the real edge. So, what should you do with this awareness? Start by tracking your feelings as closely as you track your trades. Journal not just entries and exits, but also your mood, level of stress, and physical reactions before, during, and after trades. This is how you begin to see the patterns, just as you would on a price chart. Have you noticed your hand hovering, hesitating before clicking sell, even when your plan says to? That's not a lack of discipline. That's your limbic system at war with your prefrontal cortex. The battle for trading success isn't on the chart, it's in your mind. Peterson's insight is a wake-up call. You're not just trading assets, you're trading yourself. The earlier you accept this, the sooner you'll start to see real progress. And you'll discover, just as Peterson, Douglas, and countless seasoned traders have, that mastery begins not with the market, but with mastering your own reactions to it. The journey has begun. Emotions are your ever-present companion. Whether you face them or flee from them will decide your fate in the markets. The next step: meeting the first and most powerful of these emotional adversaries. Fear quietly takes root in your mind and subtly pushes you to exit or avoid the market at the worst moments. As a trader, you know the feeling: a sudden dip, an unexpected news headline, or just a streak of red candles, and suddenly your pulse quickens. Peterson describes fear as the silent saboteur, always lurking, ready to hijack your decisions when uncertainty strikes. Have you ever broken your trading plan because of a red candle? This isn't just a rhetorical question. It's the central dilemma every trader faces. From Peterson's perspective, fear is evolutionary. Your brain is wired for survival, not for financial risk-taking. When you're confronted with potential loss, your amygdala, The part of your brain that triggers the fight or flight response fires up. In that moment, the urge to exit, to run, to protect your capital feels overwhelming. The danger? You're not responding to the market's logic, but to your own primitive wiring. Consider Peterson's recounting of trader David, who could consistently call trends on a demo account, but as soon as real money was involved, he froze. His stop loss would approach and, rather than exit as planned, he'd move it just a bit further, always hoping the pain would subside. You've been there too, justifying a bad trade, convincing yourself it'll turn around, or worse, cutting a winner short out of sheer anxiety. This is fear at work, not rational analysis. Other classic works echo this message. Mark Douglas, in Trading in the Zone, warns that fear is always the result of focusing on what you don't want to happen. The antidote, he argues, is to shift your focus to process, not outcome. But how? The truth is, fear never truly disappears. What changes is your relationship with it. Do you react, or do you respond? Peterson insists you can train your mind to observe fear, name it, and move through it. Not by force, but by acceptance and planning. Think of the countless times traders have panic sold into market bottoms or sat frozen on the sidelines as a clear setup materialized, paralyzed by memories of previous pain. Steenbarger suggests that the scars of past losses burn themselves into your neural circuitry, causing you to overreact to risk signals. Peterson backs this up with neuroscience. Chronic fear leads to habitual avoidance, shrinking your capacity to act when the opportunity is real. The market preys on your fear of missing out, your fear of loss, your fear of being wrong. Each of these triggers a unique cocktail of stress hormones, clouding your judgment. Left unchecked, fear breeds more fear. A losing streak leads to hesitation. Hesitation breeds missed opportunities. And missed opportunities reinforce the fear of losing again. This spiral is familiar to every trader who has watched a perfect setup pass by, paralyzed by the echo of past failures. But there is a way out. Peterson prescribes practical steps. The first, accept that fear is information, not instruction. When you feel that urge to exit prematurely, pause and ask, what is this fear telling me? Is it grounded in objective risk, or am I projecting the pain of previous losses? Use your trading journal not just to record trades, but to document your fear responses. Over time, you'll see patterns. Maybe you always panic after 2 losses in a row, or you're terrified of high volatility. Second, build your plan with fear in mind. Structure your position sizes, stops, and targets not just for maximum gain, but for emotional sustainability. If your position feels too big, it is. You're not weak for scaling down. You're wise. Your job is not to eliminate fear, Peterson reminds us, but to operate skillfully in its presence. Finally, practice exposure. Place small, controlled trades specifically to confront your fear in a measured way. Just as a pilot trains in a simulator, you must train your mind to withstand turbulence. Over time, you'll discover that fear loses its power when you learn to sit with it, observe it, and act according to your plan, regardless of what your amygdala screams. Remember, you will never eliminate fear from trading, but you can prevent it from dictating your actions. Your edge is not fearlessness, but courage, the willingness to feel fear and trade your plan anyway. This is the foundation for every other emotion you will encounter on your trading journey. Greed seduces you into breaking your trading plan and falling for market traps that threaten your capital. You might tell yourself that you're only looking for consistent gains, but deep down, every trader knows the intoxicating pull of wanting more. As Peterson illustrates, greed is not just a villain. It's a natural extension of the same emotional circuitry that drives fear, except this time it pulls you toward risk instead of away from it. Think about the last time you watched a winning trade accelerate past your target. Did you feel that rush, the urge to ignore your exit, to squeeze out just a little more profit? Or maybe, after a string of small wins, you decided this was your moment to double down, convinced you were on a hot streak. This is greed in action, and Peterson is blunt. Greed leads you to break your rules in the pursuit of quick riches, even as it sets the stage for the very losses you fear most. Greed is insidious because it rarely announces itself. It whispers in moments of euphoria, let it ride, just this once. You begin to rationalize, the trend is strong, the market feels different, the rules don't apply this time. Mark Douglas, in his classic warnings, calls this the illusion of control. You believe your judgment is infallible, that your lucky run will last forever. But the truth? The market punishes complacency and overreach. As soon as you abandon your discipline for just one more trade, the tables turn. Peterson recounts a trader named Lisa who grew her account by 40% in just 2 weeks, only to lose it all in a single over-leveraged position she refused to close. The wins, Lisa confessed, didn't feel like enough. I kept wanting more. Sound familiar? This isn't a flaw unique to you. It's a universal pattern. In fact, research shows that the human brain's reward circuits, flooded with dopamine during a winning streak, actively impair judgment and encourage increased risk-taking. This is why, in Peterson's words, the aftermath of greed is almost always regret. The very impulse that brings you joy in the moment becomes the pain you carry forward. You replay the missed exit, the trade that got away, the extra contracts you shouldn't have added. You vow never to let it happen again. Yet the next time opportunity knocks, greed is there to whisper in your ear. Compare this with Jared Tendler's perspective in The Mental Game of Trading. Greed is the shadow of fear. When you feel you haven't won enough or that others are making more, greed drives you to overtrade and overleverage. Greed convinces you that your rules are holding you back, when in reality, they're your only protection. It's a self-defeating cycle where the pursuit of unlimited gains almost always leads back to loss. Peterson challenges you to view greed not as an enemy to be vanquished, but as a signal to be understood. Whenever you feel the urge to chase more, pause and interrogate that feeling. Ask yourself, is this decision in line with my plan, or am I being seduced by the possibility of an outsized reward? Use your trading journal to capture these moments, detailing not only your trades, but also the thoughts and impulses behind them. Peterson's neuroscience background is clear. The brain's chemical responses to winning are just as powerful and sometimes just as destructive as those triggered by fear. The challenge for you is to recognize when greed is taking the wheel. Are you still following your process? Are you setting and respecting your targets? Or have you convinced yourself just this once that you know better than your rules? This is where discipline becomes your greatest asset. You're not trying to win every trade, Peterson reminds you. You're trying to execute your plan over many trades. Greed tempts you to break that process, to seek shortcuts, to trade for excitement instead of consistency. But every time you succumb, you hand your edge to the market. Remember, it's never just about the money. Greed is the emotional residue of scarcity and comparison, the belief that enough is never enough. Peterson urges you to cultivate gratitude for good process, not just big results. Celebrate the trades where you stuck to your plan, not just those that yielded the largest profits. In the end, it's not greed that ruins traders, it's the failure to recognize it in time. You will feel greed. That is a certainty. But how you respond is a choice. By noticing greed as it arises, by grounding yourself in your plan, and by reviewing your actions honestly, you transform greed from a saboteur into a teacher. This is how you protect your capital and your sanity for the long game ahead. Uncover the repetitive emotional cycles of hope and letdown that shape trading behavior again and again. This is the reality most traders never escape. Expectation builds as you watch a setup unfold, every tick in your favor lighting up your brain with anticipation. Then, just as quickly, disappointment strikes. A reversal, a stop out, a trade that should have worked but didn't. Peterson's research shows these emotional loops aren't random. They're hardwired into your psychology, and if you don't recognize them, you're doomed to repeat the same mistakes, trade after trade. Peterson describes how expectation, when unchecked, becomes its own trap. Every time you enter a position, there's a subtle shift. You're no longer just analyzing, you're invested. Suddenly, you want the market to prove you right. You seek confirmation in every tick, every news headline, and you start to ignore warning signs that run counter to your thesis. We don't see the market as it is, Peterson writes. We see it as we hope it will be. This isn't optimism. It's emotional blindness. The letdown when it comes is sharp. A stop-loss hit, a quick profit evaporates. Or worse, you get whipsawed out of a good trade, only to watch price move in your favor after you've exited. That sting is more than frustration. It's a blow to your sense of control. Peterson cites studies showing that losses, especially unexpected ones, trigger far more powerful emotional reactions than gains. Your mind, desperate for relief, starts searching for ways to avoid disappointment in the future. That's when bad habits take root. Moving stops, taking profits early, skipping trades out of fear. Compare this with Steve Ward's observations in Trader Mind. Expectation is the silent killer of performance. The more you want a trade to work, the more likely you are to sabotage it. Ward, like Peterson, argues that every expectation you build around outcome distracts you from the process. Your goal isn't to be right on every trade. Your goal is to execute your plan with precision and emotional neutrality, regardless of the result. Peterson uses neuroscience to explain why these cycles are so persistent. Dopamine, the brain's reward chemical, doesn't just spike on a win, it surges in anticipation of a win. The mere possibility of a big gain lights up your brain more than the gain itself. This is why you find yourself glued to the screen, heart racing, hoping for confirmation. But when hope meets reality and disappointment follows, the dopamine crash can feel like withdrawal. The urge to get back what you lost isn't just psychological, it's biochemical. What do you do when hope and disappointment start running your trading? Peterson recommends you focus on process over outcome. Easier said than done, right? But this is the discipline that separates professionals from amateurs. When you catch yourself obsessing over a trade's outcome, rechecking charts, scanning forums, recalculating potential profits, force yourself back to your plan. Ask, did I follow my process? Did I manage my risk? Did I act according to my rules? Not my hopes. This is where trading journals become vital. Document the trades where expectation took over, where you moved a stop, chased a breakout, or took profits too soon because you couldn't handle the suspense. Over time, you'll see the emotional loops. You'll notice patterns, certain market conditions, setups, or even times of day that trigger your expectation disappointment cycle. This self-awareness is your edge. As Peterson says, if you can't measure your emotional responses, you can't manage them. Consider also the wisdom from Mike Bellafiore in One Good Trade. He teaches his traders to focus on the quality of their process, not just their P&L. Celebrate the trades you executed according to plan, even if they were losers. This retrains your brain to value discipline over dopamine. The payoff? Over time, you break the cycle. You start to experience disappointment as data, not as disaster. Hope becomes a motivator, not a blindfold. Ultimately, you will always feel the pull of expectation and the pain of disappointment. The challenge is not to banish these emotions, but to manage them, to ground yourself in process, to review your patterns, to value consistency over outcome. This is the path Peterson lays out. When you internalize it, you trade not with hope or fear, but with clarity and confidence. Clarify the link between stress, anxiety, and the destructive urge to revenge trade or overtrade. If you've ever felt a tightening in your chest after a loss, an irresistible urge to get your money back right away, or a mounting pressure that clouds your judgment as you watch the screen, you're not alone. Peterson exposes a harsh truth. Stress and anxiety are not just byproducts of trading. They are constant forces that, left unchecked, will drive you to sabotage your own results. You might recognize the sequence. You take a loss, perhaps a series of them. Your heart rate goes up, your breathing shortens, your muscles tense. The loss itself is painful enough, but the true danger lies in what comes next. The compulsion to take action, to fix the situation immediately. Revenge trading is born in this crucible of stress and anxiety. It's a frantic attempt to erase the pain, to prove yourself right, or simply to silence the uncomfortable emotions churning inside. Peterson backs up this pattern with both real-life trader stories and hard neuroscience. He cites studies showing that acute stress releases cortisol, a hormone that literally changes the way your brain processes information. Under stress, you become hyper-focused on short-term outcomes and blind to the bigger picture. Your prefrontal cortex, the part of the brain responsible for rational decision-making, takes a backseat to your limbic system, which is wired for instant action and survival. When you are trading under stress, Peterson writes, you are no longer trading the market, you are trading your emotions. It's not just losses that trigger this destructive cycle. Sometimes, even after a big win, you can feel anxious, worried you'll give it all back, or desperate to repeat the feeling. Stress can push you to overtrade, entering positions without a clear plan or taking setups that don't fit your strategy. The more you trade, the more stressed you become, and the cycle feeds on itself. Peterson shares the story of James, a trader who blew up 2 accounts in a single year, not because his system was flawed, but because every time he lost, he tried to win it all back in one reckless move. This self-sabotage is so common that it's a running theme in every major trading psychology book. Brett Steenbarger warns, your urge to act under pressure is rarely your friend. Most of your best decisions will be made in a calm, focused state, not in the heat of emotional turmoil. Jared Tendler agrees. Overtrading is almost always a sign that you're trading your emotions, not your plan. How do you break free? Peterson recommends a combination of physiological and psychological interventions. First, recognize your physical symptoms of stress before they escalate. Are your shoulders tight? Is your jaw clenched? Are you staring at the screen, unable to step away? These are signs that your body is preparing for battle, not for reasoned analysis. Second, build non-trading rituals into your process. After a loss or even a win, step away from your desk. Go for a walk, practice deep breathing, or write out your emotions in a journal. This creates space between stimulus and response, giving your rational mind time to catch up with your emotional brain. Third, create strict rules around your trading frequency. Peterson suggests setting a maximum number of trades per day or session, regardless of results. If you find yourself itching to break the rule, that's your cue. You're no longer trading the market, you're trading your stress. Finally, learn to accept losses as an inevitable part of trading. Peterson, like Douglas and Bellafiore, emphasizes that your job is not to avoid losses, but to manage them without emotional overreaction. Losses are data points, not personal failures. Every trader faces stress and anxiety. The difference between consistent winners and perpetual losers is not who feels stress, but who manages it. By acknowledging your stress, setting boundaries, and stepping back before you react, you transform anxiety from a saboteur into a signal. The urge to revenge trade will always arise, but it does not have to control you. The lesson here is simple but profound. Your success depends less on what you do after a win and more on how you handle yourself after a loss. Stress and anxiety are unavoidable, but with discipline and self-awareness, they can become tools for growth rather than destruction. Examine how overconfidence and the fear of missing out, FOMO, lead you into reckless, uncontrolled trading decisions. If fear and stress can paralyze you, then overconfidence and FOMO will do the opposite. They push you into action, often when restraint is most needed. Peterson warns that these twin emotional traps are responsible for some of the biggest account blowups in trading history. And they don't just afflict beginners. Even the most seasoned traders can fall prey. Let's start with overconfidence. After a streak of wins, your sense of invincibility grows. You begin to believe you have a special feel for the market, that your recent success is proof of your skill, not just variance. Peterson shows that this isn't mere ego. It's a cognitive bias, fueled by your brain's reward circuits. When trades go well, dopamine surges and your self-assessment warps. You become convinced the rules don't apply to you anymore. The danger here is subtle, but real. You increase your position sizes. You enter trades more aggressively. You start to ignore risk management protocols that, just days ago, you insisted were non-negotiable. I can't lose, you think, until you do. Peterson's stories are sobering. Traders who turned a month's profit into a year's loss in a single day, all because they were riding the high of overconfidence. Mark Douglas captures this perfectly. The best traders aren't always right, but they are always disciplined. Now add FOMO to the mix. Social media, chat rooms, and even your own watch list bombard you with stories of huge moves you should have caught. The fear isn't just of missing profits, it's of falling behind. You see others making money, and suddenly every move feels urgent. FOMO whispers, if you don't act now, you'll regret it forever. In this state, you start chasing trades, entering late, ignoring setups that don't truly fit your strategy, all in pursuit of someone else's success. Peterson highlights how FOMO is amplified by the very structure of markets. Breakouts, sudden news, or sharp reversals are engineered to provoke an emotional response. He references experiments showing that people are far more likely to take irrational risks when they perceive an opportunity slipping away. Your brain treats missed trades as actual losses, triggering the same pain circuits as a losing trade. What's the solution? Peterson, like Tendler and Steenbarger, prescribes humility and process above all. First, recognize that overconfidence is a byproduct of short-term success, not long-term skill. Whenever you feel invincible, ask yourself, am I still following my process, or am I winging it? Build in routines that force you to stick to your plan, like reviewing your rules before each session or capping your position size no matter how sure you feel. With FOMO, Peterson urges you to remember, there will always be another opportunity. You don't have to catch every move. If you find yourself wanting to jump in because everyone else is making money, step back. Review your trading plan. Ask, does this setup fit my edge, or am I just reacting to the crowd? Journaling your FOMO trades will quickly show you that, more often than not, the ones you chase don't work out. It's also crucial to set social media boundaries. Limit your exposure to trader highlight reels, which distort your perception of what's possible or necessary. Peterson suggests turning off notifications during trading hours and doing a social media audit when you notice a spike in your FOMO-driven decisions. Remember, trading is a marathon, not a sprint. Overconfidence and FOMO want you to believe otherwise. They thrive in urgency, in the belief that this trade right now is your only chance. The antidote is patience, grounding yourself in process, being content to wait for your true setups, and reminding yourself that missing one opportunity is always better than blowing up your account. Peterson's final word is firm. The market rewards discipline, not bravado. Your job is not to catch every move, but to master your emotions, especially the ones that convince you you're invincible or that you're being left behind. In trading, as in life, humility and restraint are your greatest assets. Dive deep into mental traps like confirmation bias and loss aversion, and how they distort your trading outcomes. No matter how rational you believe you are, your mind is hardwired to trick you, especially when money is at stake. Peterson's research on cognitive biases reveals a simple truth. Your brain is not naturally designed for the demands of financial markets. If you're not aware of these psychological pitfalls, you will walk right into them again and again. Let's start with confirmation bias. Imagine this. You've spent hours developing a bullish thesis on a stock or currency pair. As you scan news, charts, and forums, you find yourself unconsciously filtering for information that supports your view. You ignore warning signs, dismiss negative headlines, and amplify every piece of data that confirms you're right. Peterson explains, the more emotionally invested you are, the more blind you become to contrary evidence. The trap is seductive because it feels logical, but in reality, it's emotional self-preservation masquerading as analysis. Peterson recounts the story of Sophie, a trader who repeatedly doubled down on her initial bias despite clear signals to exit. Each time the market moved against her, she scoured Twitter for voices that validated her view and dismissed anything that contradicted it. Her results? Predictably poor. It wasn't the strategy that failed. It was the blindness created by her need to be right. Mark Douglas echoes this danger. You don't need to know what's going to happen next to make money. You just need to accept what is happening right now. Loss aversion is another universal trap. Nobel laureate Daniel Kahneman and Amos Tversky showed that losses are psychologically twice as painful as equivalent gains are pleasurable. In trading, this means you're more likely to hold on to losing trades, hoping they'll turn around, than to accept a small, manageable loss. Peterson's neuroscience lens shows why. Your brain's pain circuits light up on a loss, and your first impulse is to avoid that pain, even if it means making things worse. Cutting losses quickly is easy in theory, excruciating in practice, he notes. The result? You move stops further away, ignore your exit signals, or refuse to log out of a losing trade. Each act of avoidance feels like relief in the moment, but compounds your pain in the long run. Peterson describes Tony, a futures trader who would let losses run far past his limits. He admitted, "I'd rather hope than feel the shame of being wrong." But hope is not a risk management strategy. In fact, it's the fastest path to blowing up your account. Compare this with Jared Tendler's take in The Mental Game of Trading. You're not losing money because of the market. You're losing because your mind is making you irrational. Biases are not a flaw. They are a universal feature of human cognition. Your edge is not to eliminate them, but to recognize and manage them. How do you protect yourself from these traps? Peterson prescribes radical self-awareness. First, before entering any trade, write down your thesis and what would prove it wrong. This forces you to confront disconfirming evidence before you're emotionally invested. Second, review losing trades not just for technical errors, but for signs of bias. Did you ignore signals, cherry-pick data, or hold on to a loser out of pride or fear? Next, create if-then plans. If the market does X, I will do Y. No negotiation. This reduces the wiggle room your mind uses to rationalize bad decisions. Peterson is clear. Your plan must be specific enough to override emotional reasoning in the heat of battle. Finally, build a culture of accountability. Share your trade rationales and post-trade reviews with a trusted peer or mentor. The act of verbalizing your reasoning helps expose hidden biases. As Mike Bellafiore says, your best trading comes when your ego is small and your process is big. Your brain is built to deceive you, but you are not powerless. By shining a light on confirmation bias, loss aversion, and other traps, you transform them from invisible threats into manageable risks. This is the deep work of trading psychology, the discipline to see clearly, even when your emotions want to see something else. The real challenge isn't the market, it's your own mind. Recognize these biases, and you reclaim your power as a trader. Evaluate how excessive optimism, subjectivity, and underestimating risk can be just as dangerous as negative emotions. It's easy to focus on fear and greed as the primary villains in trading, but Peterson makes a bold case. Toxic positivity and unchecked subjectivity often ruin traders more quietly, yet just as completely. If you're always convinced things will work out, or if you only see what you want to see, you're walking into the market with your guard down. Peterson describes traders who mistake confidence for certainty, who turn hope into a strategy, and who, blinded by recent success, downplay the real risks. The markets don't care about your optimism, Peterson warns. They punish complacency and reward preparation. He tells the story of Eli, a trader who, after a strong month, became convinced he had cracked the code. When volatility hit, Eli ignored new risks, failed to adapt, and lost more in a week than he'd made all month. His downfall wasn't panic or fear. It was positive delusion. This over-optimism often disguises itself as rational analysis. You might find yourself overestimating your system's accuracy after a hot streak, or brushing aside red flags because the trend is your friend. But as Peterson and other experts, like Mark Douglas and Brett Steenbarger, show, your brain loves to remember winners and forget losers. This natural subjectivity can cloud your judgment, making you believe you're immune to risk. Subjectivity also creeps in through selective memory and personal bias. You interpret ambiguous data in your favor, adjust your backtesting to fit your beliefs, and cherry-pick trades that reinforce your narrative. Peterson notes that this isn't just harmless optimism, it's self-sabotage. The more convinced you are that this time is different, the less prepared you are for reality. Peterson backs his arguments with neuroscience. Positive emotions, when unchecked, can flood your brain with dopamine, creating a false sense of security. You become addicted to the feeling of rightness, taking shortcuts or skipping steps in your process. Over time, your trading becomes less about objective analysis and more about feeding your own positive expectations. Compare this with Douglas's lesson. Your job isn't to predict, it's to execute with discipline. Every time you put optimism ahead of risk management, you violate this fundamental rule. Or as Bellafiore teaches, risk first, profit second. Even the most well-reasoned thesis can blow up if you ignore the possibility of being wrong. So what can you do to protect yourself from the dangers of toxic positivity and subjectivity? First, Peterson urges you to stress test your assumptions. Ask, what am I not seeing? What's the worst-case scenario? Run through adverse outcomes before you enter a position, not after. This practice, common among institutional traders, helps you stay grounded. Second, develop objective routines and checklists. Use them before every trade. These force you to check your optimism at the door and evaluate risk, technicals, and market context without emotional interference. If your analysis fails to meet the criteria, stand aside, no matter how good it feels. Third, track your emotional state as carefully as your P&L. Peterson recommends rating your confidence level before each session and reviewing your trades for signs of overconfidence, subjectivity, or risk blindness. Over time, you'll see patterns. Perhaps you trade worst after a winning streak, or you size up too aggressively when everything is going right. Finally, invite challenge. Seek out opposing views and make it a habit to debate your trades with others, especially those who don't share your biases. As Steenbarger notes, robust trading is built on the ability to see both sides of the market, not just the side you want to see. Toxic positivity and subjectivity are dangerous because they lull you into a false sense of control. Markets reward preparation, humility, and objectivity, not wishful thinking. By grounding your optimism in risk management, building routines that enforce objectivity, and actively seeking out your blind spots, you transform positivity from a liability into a real edge. Remember, in trading, reality always wins. Stay vigilant, stay humble, and always be ready to see what you don't want to see. Breaking the plan. This is where even the most carefully crafted trading systems crumble under the weight of emotion. Think of a time when you made a promise to yourself. This is my plan. I will not deviate, no matter what happens. Now remember the very first moment you broke that promise. It probably didn't feel dramatic at the time. Just a quick adjustment, a little flexibility, a rationalization that this one time is different. But that small crack in discipline is where emotional pressure exerts its greatest force. Peterson argues that this is the single most common source of trading regret, not the losing trade itself, but the split-second surrender to emotion that led you to break your rules. The power of the moment is overwhelming. When your position moves sharply against you, your plan suddenly feels inadequate. Fear and panic demand immediate relief. When your trade rockets higher, greed whispers that you should let it ride just a little longer. And when you're on a losing streak, stress and anxiety can convince you to revenge trade, making wild decisions you would never have considered at the start of the session. It's not a question of intelligence or experience. Some of the world's best traders admit that, in the heat of battle, emotion can overpower reason. The market is a master at manufacturing urgency. Red candles flash, order books thin out, and your heart rate spikes. In these moments, time seems to shrink. There is only now, and the pressure to act, to change your plan, is immense. Peterson shares the story of Ben, a disciplined trader who spent years perfecting his entry and exit criteria. But when volatility exploded in a single session, Ben ignored his stop, hoping to wait out the noise. The result was a catastrophic loss, not because his strategy failed, but because, under emotional fire, he abandoned it. Ben's words echo what so many traders confess. I didn't lose to the market. I lost to myself. Other trading psychologists agree. Mark Douglas teaches that consistency is a function of state of mind, not technique. The more emotionally aroused you are, by fear, greed, hope, or anger, the more likely you are to seek comfort in the short term by violating your plan, even when it guarantees pain in the long run. Jared Tendler calls this the moment of truth, that fleeting second where you choose between your process and your emotions. Think of the just this once mentality. Maybe it starts with moving a stop loss a few points further, skipping your morning prep because you're in a rush, or doubling your size because you feel behind. It rarely ends with a win. In fact, Peterson's data shows that trades taken outside your plan have a significantly higher failure rate and create far more psychological damage than normal losses. So, how do you withstand the pressure of the moment? Peterson's advice is to make your plan as automatic as possible. That means reducing decision-making in real time, using hard stops, preset targets, and even automation to prevent in-the-moment interference. He recommends reviewing your plan before every session, visualizing yourself sticking to it under stress, and rehearsing your if-then rules until they become second nature. Accountability is also key. Share your plan and results with someone you trust, a mentor, trading partner, or even a journal. The act of reporting, Peterson says, creates a psychological speed bump that can interrupt impulsive behavior. Mike Bellafiore puts it bluntly. If you can't follow your plan in the heat of the moment, the market will teach you with pain. But most importantly, forgive yourself. Every trader will break their plan at some point. The lesson isn't to become perfect, but to become honest. Document those moments, study them, and commit to improvement. Every broken plan is a window into your emotional blind spots, and the best traders use those windows to build stronger discipline. In the end, trading is a game of preparation and response. You can't control the market, but you can control your process. The pressure of the moment is inevitable, but whether you yield to it or hold your ground will determine your fate in the markets. End with actionable methods for recognizing and controlling emotions, synthesizing Peterson's lessons with other top trading psychology experts. At this point in your journey, you know that emotional awareness isn't just an extra, it's your edge. The final step is learning how to build true mastery, day in and day out, regardless of what the market throws at you. Peterson's first prescription is self-monitoring. Before you trade, check in with yourself, physically, mentally, emotionally. Are you carrying stress from your day job? Did you sleep well? Is your mind clear or clouded? Rate your emotional state before each session. If you're already tense or agitated, reduce your size, trade less, or step away. As Peterson notes, you cannot win if you're not prepared to be honest with yourself first. Next, develop structured routines that force discipline, even under pressure. Mike Bellafiore calls this process over prediction. Pre-market checklists, written trade plans, and regular journaling build habits that protect you from impulse. Peterson advocates visualizing market scenarios and rehearsing your reactions. If my stop is hit, I exit. No negotiation. By rehearsing emotional events, you make the right decision automatic. Risk management is your emotional anchor. Peterson is uncompromising. If your position size feels too big, it is too big. Use small, consistent size until you are immune to panic. Hard stops and targets must be set before you enter, not after emotions take over. As Mark Douglas reminds you, your job isn't to predict, but to execute with discipline. Social support matters too. Find a trading buddy, mentor, or community, someone who will challenge your blind spots and celebrate your discipline, not just your wins. This creates a feedback loop. You become accountable, you're less likely to rationalize emotional decisions, and you grow faster. Jared Tendler emphasizes the importance of post-trade reflection. After each session, review not only your results, but your emotional responses. Did you feel anxious, greedy, hopeful, angry? How did you act when those emotions hit? Document the triggers, the decisions, and the outcomes. Over time, you'll see patterns, and once you see them, you can change them. If you're struggling with recurring emotional mistakes, consider formal tools. Mindfulness training, breathing exercises, even brief meditation sessions can rewire your emotional responses. Peterson points to research showing that even a few minutes of mindful breathing lowers cortisol, sharpens focus, and builds emotional resilience. Most importantly, accept that emotional mastery is never complete. You will always feel fear, greed, hope, and disappointment. The difference is in how you respond. Peterson, Douglas, Tendler, and Bellafiore all agree. The best traders aren't emotionless. They're emotionally fluent. They feel, they notice, and they act according to plan anyway. So here's your challenge. Each morning, rate your emotional state. Each trade, follow your process, no matter what you feel. Each evening, review and reflect with honesty and zero judgment. Over time, you'll notice a transformation, not in the market, but in yourself. This is the real victory. Because at the end of the day, trading isn't about beating the market. It's about mastering yourself. Every chart, every trade, every win and loss, they are all opportunities to train emotional discipline. The traders who succeed long-term aren't the smartest or the fastest. They're the most self-aware and the most committed to their process. Make emotional mastery your trading edge. Your job isn't to be perfect. It's to show up, to notice, to learn, and to get a little bit better every single day. You've traveled through the emotional landscape of trading: fear, greed, stress, overconfidence, bias, subjectivity, and the relentless pressure of the moment. You now know that it's not just strategies or signals that determine your success, but your ability to recognize, understand, and manage your emotions in real time. Richard L. Peterson, echoing the wisdom of Douglas, Tendler, and Bellafiore, makes one thing clear: trading is an inside job. The real market is your mind. Every story and lesson you've just heard reflects the reality faced by all traders, from rookies to professionals. The urge to break your plan, chase losses, or ride the high of a winning streak? These aren't flaws. They are part of being human. The difference between those who thrive and those who falter is simple. The winners are relentlessly self-aware, humble enough to admit their mistakes, and disciplined enough to learn from every experience. As you move forward, commit to making your emotional responses visible. Journal your feelings, review your patterns, and never trade without a plan. Celebrate the trades where you honored your process, not just your profits. And when you slip, as every trader does, use those moments as a mirror, not a whip. This is how you grow. If you're ready to put these lessons into practice, start by reading Peterson's Psychology for Traders, then branch out to Douglas's Trading in the Zone or Tendler's The Mental Game of Trading. Absorb, apply, and iterate. Remember, every trade is a chance to practice discipline, build self-awareness, and sharpen your edge. If this video resonated with you, please like, comment with your biggest trading challenge, and subscribe for more deep dives into trading psychology. Your journey to mastering yourself and the market starts right here.